The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to Nova's presentation of 401k Loan and Distribution Basics with Melissa Kaywood and Stephanie Reed. Before we get started, I'd like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions and chat. This is where you will enter in any questions that you may have for Stephanie and Melissa. Please keep in mind that the Q&A portion will be held at the end of the webinar, and they will answer as many questions as time permits. If time does run out and you still have questions, you can send them to our email address, webinars@nova401k.com. Right below questions and chat, you will see the handouts drop down. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out the pop-up survey. This will allow us to track your time and participation. Your certificate will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce from Nova's Distribution Department, our head reviewer, Melissa Kaywood, and team leader, Stephanie Reed.
Hey, hello everyone. Welcome to our webinar on 401k Loan and Distribution Basics. I am Stephanie Reed, and I will be starting off, and then we'll switch a little bit later on to Melissa. Just a quick disclaimer here. So the information that we're presenting is meant to be general in nature. It's not intended to be a substitute for legal or tax advice. So please feel free to consult a qualified professional or an attorney or an accountant if you need legal or tax advice. And if you need CPA credit, that just kind of went over the procedure for doing that. This slide also has some information on it. It has our provider number. And again, as long as you're present for the entire webinar and complete the evaluation form, we'll send you the certificate within a week of the webinar. So our agenda today, we're going to go over distribution basics. I'm going to discuss the distribution types. I'm also going to go over the special tax notice and some special taxation issues for distributions. And then I'll be turning this over to Melissa Kaywood, and she will be discussing loan basics. She's also going to discuss vesting, and she's going to discuss some of the more common problems we see with distribution administration, as well as go over our cybersecurity policy. When we finish the webinar, we're hoping that you will come away with certain information. We hope that you'll understand the mandatory and optional distributions that 401k plans have. We also hope that you'll be able to identify loan provisions and loan requirements, and also understand how vesting applies for loans and distributions. So before I jump in here, one of the things about 401k plans is that they are governed by a variety of tax rules. And the rules govern, contributions made to the plan, how the plans are operated, and how the funds can be withdrawn. So some of the more common distribution options in 401k plans are listed below. This is not an exhaustive list, but some of the most common ones we see are termination of employment distributions and retirement distributions. We also process a lot of age 59 and a half in-service distributions. These are distributions that participants request while still employed. We also process hardship distributions. We see death and disability distributions. And then another common distribution is a rollover distribution. And what we mean by rollover distribution here is distribution of funds that the participant has rolled into the plan from a prior plan. A lot of retirement plans allow participants to take those rollover funds out at any time. The most common distribution we process by far is a termination of employment or retirement distribution. It's important to note that these are voluntary distributions. The participant has requested to have the funds paid out of the plan. And a couple of important things to keep in mind for these distributions is that the funds can't be released from the plan until the participant has actually terminated employment. So for example, if I know I'm going to terminate employment, 2 weeks from now, I can't take a distribution today because of that future termination date. I actually have to be terminated before I can take the distribution from the plan. And then another thing on distribution timing is this final payroll contribution. So it's very common in 401k plans that a participant terminates employment and then immediately requests a distribution, but there's still one more payroll contribution that has to be deposited to the plan. And we encourage our plan sponsors to hold their distributions until after this final payroll contribution is made. And the reason for that is that if participants take a distribution now and then get another contribution, most record keepers will require them to request a second distribution. They'll have to pay a distribution fee for that, so they're paying a second distribution fee. And a lot of participants don't make that second distribution request. So you can end up with a lot of really small balances in your plan if you let participants take their final distribution before they get the final payroll contribution. Another type of termination distribution that we process a lot of are involuntary force-out distributions. And these are distributions that allow the plan to remove small account balances so they don't have lost participants in their plan. So it's really common for participants who've terminated and not requested funds to kind of get lost over the years. So they move and they don't update their address, for example. And over time, you'll get these accounts in retirement plans where you don't know where the participant is. And this is more common for smaller account balances. So we have this option of having involuntary force-out distributions to remove them from the plan and help manage this lost participant issue. Plans can adopt one of two force-out thresholds. There's a $1,000 threshold or a $5,000 threshold. And I'll give a little more information about that in the upcoming slides. A few things to keep in mind about these involuntary force-out distributions are that these are employer-initiated distributions. So these are situations where the participant has not made an election. And when we process these, participants are given a time period to make an election. So they'll give a notice that will give them 30 days to respond if they want to make their own distribution election. And if they don't respond, they're forced out at that point. When we're looking at those $1,000 and $5,000 thresholds, we're looking at just the vested account balances for the participants. And we can include rollover balances or we can exclude them when we're calculating that 1,000 or 5,000 threshold to see which participants are eligible to be forced out of the plan. That's going to be a plan document election. So if you set your threshold for the under 1,000 at $1,000, typically these distributions are paid as cash distributions, which means they're taxable to the participant, and they also include a 10% early withdrawal penalty for certain participants, and this is typically going to be participants under age 59 and a half. In these situations, the participants mailed a distribution check for 80% of their balance, and then a federal withholding amount of 20% of the balance is sent to the IRS to apply against the participant's taxes for that year. One of the issues with cashing participants out as cash distributions is that this can create an uncashed check issue for the plan, meaning that a number of these checks don't ever get cashed by participants. They may not open the check, for example, or it may be a small amount and they just decide not to do anything with it, but it is pretty common that these checks are not cashed. So one of the things you can do to combat that is have your force out for distributions under 1,000 be a rollover to an IRA. And this is actually what we encourage our plans to do. And the way we process most of our force outs here at NOVA is we have all force outs be rollover IRAs, and we don't do very many cash distribution force outs. If you set your force out at 5,000 instead of 1,000, anything over 1,000 and up to 5,000 does have to be processed as an IRA. You can't do a cash distribution or a force out that's over $1,000. So if you're setting it at $5,000, having it be rollover, whether it's under 1,000 or over 1,000, is also just a little bit easier to administer. It's a little more consistent for the participants as well. If you have questions on the force out provisions available in your plan, you can feel free to reach out to the distributions department. Our email is right here on the screen, distributions@nova401k.com. And you can also reach out to your plan's account manager to discuss any of your plan's provisions, including your plan's force-out provision. Another really common distribution provision in 401k plans is an age 59 and a half in-service distribution provision. And the reason why we have these at age 59 and a half is 59 and a half is kind of a magic age in 401k plans for distributions. It's the age at which the 10% early withdrawal penalty doesn't apply. It's also the age where the IRS says, you're allowed to take your 401k, your employee contributions out of the plan while still being employed. So that's why you will see this set at age 59 and a half. It's not required, it's an optional plan provision. It's pretty common, but not all plans have it. And again, this allows employees to take distributions while still employed. You can restrict it to different source types. It's common to restrict this to employee contributions only and not allow participants to take employer money. And again, it's not subject to the early withdrawal penalty since you're 59 and a half, but it is still taxable income. So participants will have to pay income taxes on their age 59 and a half withdrawals. Another common distribution provision for 401k plans is the hardship distribution. Again, like the 59 and a half, this is an optional provision, but it does give participants access to their account when they have emergencies. On the next slide, I'll kind of go through the hardship emergency list for hardship distributions. But one thing to keep in mind for participants is that if they're under age 59 and a half, they will pay the 10% early withdrawal tax on hardship distributions, and they are subject to income taxes. They also may have some documentation requirements, so they can be a little more complicated to administer than a simple termination distribution. So the IRS gives us some safe harbor hardship reasons that we can include in plan documents, and that we have confidence that these reasons are going to be allowed and they're not going to be questioned if the plan's audited. And the list is right here. The purchase of your primary residence, and this doesn't include mortgage payments. This is going to just include the costs for purchasing the residence, the down payment, all the other closing costs, etc. Hardships can also be approved to prevent eviction or foreclosure from your primary residence. And in these cases, we're looking for documentation stating that the participant is actually in danger of eviction or foreclosure. So simply being late on your payment is not necessarily qualifying for a hardship, because you may have to be multiple months late before you're facing foreclosure or eviction. Also, another hardship is for unreimbursed medical expenses. So expenses not paid by insurance, and this can actually apply for the participant, their spouse, or their dependents. Same thing with the post-secondary education. Participant, spouse, or dependents can qualify for that. Another one is casualty losses, and these are typically going to be things like fire, flood, really extreme events that have resulted in, damage to your home. So that can be eligible for hardship distribution. Funeral or burial expenses can be eligible for hardship distributions. And then the other situation where you can get a hardship is if you live in a federally declared disaster area. For example, if you live in a hurricane area, your house was damaged by a hurricane. If you live in a federally declared disaster area, you can get hardship to help with those expenses. Going to go over this briefly. These are some changes that were made a few years ago, but I think it's still worth mentioning them because not everyone is aware. But since 2019, we have had some pretty sweeping changes to hardship distributions. Before then, participants had to take a loan before they could request a hardship, but that's no longer required. Participants don't need to take the loan first anymore. The other thing that was a big change were the investment earnings. So prior to 2019, investment earnings on the employee contributions could not be used for the hardship. But this changed in 2019, which has made hardships easier to administer since we don't have to track the earnings separately and the hardship distribution separately. There used to be a requirement that you had to stop contributing to your 401k plan for 6 months if you had a hardship, but this also went away in 2019. And these provisions are all already part of your plans. They have been for the last few years. So this is the way your hardships are being administered now. There's some additional requirements for hardship distributions just to keep in mind. So employer contributions can be available for hardships, but they're not required. You can just restrict it to the employee contributions. Another change that happened in 2019 is that safe harbor employer contributions were made eligible for hardships, as were qualified non-elective and qualified matching contributions. These were not eligible before 2019, but they currently are, and it's optional. You don't have to allow those amounts, but they can be used for hardship distributions if the plan document allows it. You may have to provide some documentation for hardships. Some of these documentation rules are actually changing, and we have a webinar a little bit later this month to go over those changes, but there are documents that may need to be provided depending on how the plan is administering hardships. And then the other thing to keep in mind is that all participants will have to sign a certification for the hardship withdrawal. And the certification essentially says that, you know, they have this hardship and they don't have any other way to pay for the hardship, which is why they are requesting the funds from the plan. And another type of distribution that we do see is rollover source distributions. And these are available just for participants that have a rollover source in the plan because they've rolled it over from a prior plan. And this again is an optional provision, but it's really common to see in plans. And one of the reasons is that it encourages participants to roll funds into your plan from their prior plan. So it can help, you know, increase the account balances in your plan, which can help reduce your plan expenses. These are subject to federal income tax, however, if they do take withdrawals from the plan, and also the 10% penalty tax if they're under age 59.5. And another unfortunate distribution we do see sometimes are death distributions, and these are participants who have unfortunately passed away, and their beneficiaries are able to take distributions from the plan. It's really important that plan sponsors maintain beneficiary designations so that if a participant does pass away, you know, we know how they wanted their funds to be paid. Married participants are the default if you are married, and that's just a law that spouses have to be the default. If a participant wants to designate someone other than a spouse, they can do that, but they do have to get their spouse's written permission to do that. If the plan doesn't, or if the participant doesn't have a beneficiary designation, then the plan document will state how the distribution should be paid out. Typically, it will go to spouse first if there is one, and then if not, it will go to any surviving children. If there are no children, it will go to parents, and then, you know, the list can go on. Eventually, usually it will get to the estate if there are no beneficiaries that can be located. And just when you do submit a death distribution, you should attach a copy of the death certificate. Most of the record keepers do require that to process a death distribution form. Another distribution that we process quite a lot of are required minimum distributions, and these are age 73 distributions. They used to be age 72 distributions, but the age was just increased to 73. And this is an annual requirement for participants over age 73. And we do have situations where a participant over age 73 will retire and request to roll their account to an IRA, for example. And in those cases, we do require the participant to take the RMD first before we can process the rollover. So in those cases, a participant will often have two distributions. They'll take the RMD first, and then they can roll over the remaining account balance. As far as who has to take RMDs, so terminated participants who are age 73 or older have to take RMDs every year. And then active participants that are 5% owners will have to take them when they reach age 73. So if you own more than 5% of a company and you reach age 73, you'll have to take RMDs even if you're still employed. And one of the things we have to look out for here is attribution. So for example, if your spouse owns 5% of a company or your child owns 5% of a company that you work for, and you're over age 73, you'll be required to take an RMD. And then Nova does initiate RMDs for their clients every year. We have a big RMD project that we'll do for all of our clients to try to identify and pay out all of these RMD eligible participants. Another distribution that we do process some of are qualified domestic relations order distributions. These usually come up in the context of a divorce. You know, participant will divorce and their spouse will be rewarded a portion of their retirement account. There's a court order involved with it and the rules are a bit complicated. It's, you know, one of the important things just to remember about qualified domestic relations order distributions is that it can be a lengthy process. The court order has to be qualified. Sometimes we also will get draft orders and then the final order a few months later. So it can take, you know, potentially several days to several weeks to process, fully process a quadro distribution. As far as spousal consent goes, for most 401k plans, spousal consent is not required. For plans that do have spousal consent, it's usually only required for distributions that are over $5,000. Typically in a 401k plan, you'll see a spousal consent if the plan has old money purchase plan money in it. Otherwise, you don't usually see those. Where you'll usually see a spousal consent provision is in a defined benefit pension plan. So, you know, traditional pension plans do have spousal consents, but most 401k plans do not require spousal consent. Along with distribution processing, most participants receive special tax notices along with their distribution requests. And these special tax notices provide information for the participants on the taxation of their distributions. It explains how they can defer taxes and also what taxes they'll pay if they take cash distributions. So it's a really important document to make sure that you're distributing to your participants when they request distributions from the plan. And as far as just general taxation issues with 401k plans, typically, cash distributions are going to be subject to 20% federal tax withholding, and a 10% early withdrawal penalty may apply if they're under age 59 and a half. And it's just important to know that if you do take a cash distribution, it's going to be taxable income. I'm sorry, I went a little too far. Some distributions are exempt from the mandatory 20% tax withholding. So for example, hardship distributions or RMDs are exempt from the 20% tax withholding rule. They're still taxable income to the participant, they just don't have to have withholding at the time of distribution. If you have a rollover distribution, for most of those you can defer taxation. Those can be rolled over to IRAs or to another retirement plan. Hardship distributions and RMDs are not able to be rolled over. One thing to keep in mind is if you roll over pre-tax to a Roth IRA and do a Roth conversion, that will be taxable, but it's not subject to the 10% early withdrawal penalties. So that's something for participants to keep in mind if they're doing those conversions. With that, I'm going to go ahead and turn this over to Melissa so she can go through the loan basics with you.
Hey, thank you, Stephanie. Okay, so we're going to take a few minutes here and switch gears to talk about loans. As with anything, there are pros and cons to loans, so we're going to get through it. These are optional. You can add them if your plan does not have them currently, or you can take them out if you decide that that works better for your company. But a good thing about loans is that they allow the employees to access their funds inside the plan when they might otherwise not be eligible for any of the distributions we previously talked about. And this can encourage participation in your plan. If a participant is worried that they're not going to be able to access their money in case of an unexpected event coming up in their lives, knowing that they have a loan option will encourage them to go ahead and still participate. Even if they can't quite take a distribution when they want to, they can still access money. Loans can be a little bit of an administrative burden. So and one way to kind of fix that is that you can put some restrictive provisions in there. And we'll talk about that a little bit as we go through it, but you don't have to have loans be a complete free-for-all. You can make them very conservative rules in your plan document so that they aren't too hard to administer. Loans are not taxable distributions, so they will never be taxed as long as they are paid back to the plan. And those loan repayments would be done through payroll deductions. So that makes it really easy for the participant to make sure that they don't have to worry about signing a check and mailing that in for their payment every time. It's done automatically through the payroll system. So if you wanted to add loans, you would have to get an amendment for your plan, and then you would have a loan policy prepared that would detail all of the different provisions that you have. So the maximum amount that a participant can take is 50% of their vested account balance up to $50,000. That $50,000 is also going to be reduced by the highest outstanding loan balance during the last 12 months for that person. So we have a few examples coming up, and we'll dive into that specific part of it during those examples. One way you can make loans easier to administer for your company is by using some of our recommendations. We recommend that you do not allow more than one loan at a time. So participant wants a new loan, they need to pay back their current loan before they can take another one. If you have a minimum loan amount put into your policy of $1,000, that will definitely help. The point of these plans is to save, build up our account balances, and save for our retirement. So by having a minimum loan amount that's a little bit higher, that will encourage the participants to grow their account balances. And we don't generally recommend spousal consent. It can be added to the loan policy if that's something that you want for your specific policy, but generally that's not necessary. So there are some requirements that the regulations state we have to stay within, and one of them is that loans have to have a reasonable rate of interest. The word reasonable can mean different things to different people. So you'll want to check your loan policy. The way that we write interest rates into the loan policy is that we look at the prime rate. And our loan policies typically have prime rate plus 2%. Basically, it should match relatively closely to what you might expect if you went to a bank and applied for a loan at a bank. The maximum amount of time that you can take to pay a loan back is 5 years. You get an exception on this if the loan's purpose is to have the participant purchase their primary residence. You can build in to your loan policy a different length of time for that. I've seen 10 years, I've seen 20 years. But generally for a general purpose, everyday loan, it's going to be 5 years is the max. Those loans should be paid through payroll deduction. You should not be relying on your participants to remember to make their own loan repayments because life happens and they won't. And we don't want to have any loan defaults happening. You'll notice in parentheses there, it says on a post-tax basis. So basically you get the participants, in the payroll system, the last thing you take out is that loan repayment. So taxes have already been taken out of their check and then the loan repayment comes out. So people don't really always understand that you're going to be taxed on your paycheck, you take the loan payment out, and then it goes back into the plan. If you took that money for your loan from a pre-tax source, it's going back into a pre-tax source. So it's just something to be aware of. And then loans generally become due upon termination of employment. So if you weren't quite done paying on that loan and then you quit your job, the balance of the loan is due. If you do not pay that loan off, then you will have to pay taxes on the outstanding balance. So we'll talk about a little bit more on a couple slides coming up. So if we do not follow the different loan requirements, then the loan is considered a prohibited transaction. And this can cause some pretty harsh tax penalties for the participant. The loan will be subject to taxes, and that is going to include those early withdrawal penalties. So especially if it's a larger loan, that can be a pretty big burden for the participant. Your loan policy will be very important. You want to know what's in there, and we'll make sure that every loan falls, is being administered within that loan policy. So no 6-year loan repayment schedules, things like that. We want to stay within our parameters. There are fees to initiate a loan. NOVA and your record keeper will have an initiation fee. Record keepers will also charge an annual maintenance fee. Some record keepers do it on a monthly or a quarterly basis, and some just do it annually. NOVA does not have any maintenance fees. And then just know that the participants are the ones that bear the cost of the loan. So those fees are going to come straight out of their accounts. It's not something that you as a plan sponsor would have to worry about. When somebody requests a loan, the very next question is, how soon can I get my money, of course? So by understanding the process for your specific record keeper ahead of time, that will definitely help speed up the process. Some record keepers do not allow paper forms at all, and they force everybody to go online. Some do have the option of online or paper, but if it's available, always have your participants request that loan online. We can't have the issue of missing pages or an account number that's hard to read, or a blurry fax coming in delaying us. Also with online, we have the ability to use automation, and so things just move a lot faster with online requests. For the participant, if they can request an ACH or a wire instead of having a paper check mailed to them, that will obviously speed up the process a lot. And then the participants just need to understand that they have to allow sufficient time to receive the funds. If they did request a check to be mailed to them, it's going to take 7 to 10 days for that mail to arrive. So just they need to keep that in mind. Okay, let's get into some examples. Participant A, this is very straightforward, easy one. Their vested account balance is $2,000, and they're requesting a loan for $1,000. They want that loan paid back in 2 years. Would we approve this request? So the plan document in this case does allow for one loan at a time with a minimum $1,000 withdrawal. We look at 50% of their vested account balance. That's $1,000. That matches what they're requesting. So yes, we would definitely process this loan for them. One thing to keep in mind, when people have a vested account balance that is barely at what they need in order to take a loan, if the markets drop and their account balance drops, that loan request is going to have to be put on hold until the account balance goes back up again. So just in these times with the markets kind of being all over the place, it's just something to keep in mind. Okay, the next example, we have a participant who has a vested account balance of $2,000, but that includes an outstanding loan of $400, and they want to take a new loan of $1,000 that they're going to pay back in 1 year. So would we approve this request? In this case, the plan document does allow for 2 loans at a time, so that's good. The minimum with loan amount is $1,000. So we're going to look at 50% of their vested account balance. That's $1,000. So that would be good, but we have to account for the loan that's already outstanding. $400 of that account balance already belongs to a loan. So have a little math formula there. We have to subtract out the 400 from the 1,000, giving them a maximum loan of 600. Because that's less than the $1,000 minimum, we would not be able to approve this loan for this person. They would have to pay that first loan back or have their account balance go up enough to where their minimum loan amount would be $1,000 again. Okay, last example, we have participant C. They have a much larger account balance at $100,000. They took a loan in February of $30,000, and then they fully repaid it earlier this month. Now, let's just say that in May, they're going to apply for a second loan. How much loan can they get? So we have to account for the highest loan balance in the last 12 months when we're doing these loan calculations. When we subtract their highest balance from the maximum amount of $50,000, their maximum loan is only going to be $20,000. So that's something that a lot of people don't realize. If you have a participant with a very large loan balance and they're wanting to pay it off with a goal of taking a new loan, I would recommend that they reach out first to NOVA or to their record keeper and find out what their maximum amount would be before they go ahead and pay that loan off. I have seen people scrounge for money to pay off a loan just to turn around and request a new one and be told that they can't even get as much as they just paid back because of this rule right here. So it's something that we want you guys to be aware of. Okay, so now let's talk about loan defaults. Obviously, a loan default is something we want to avoid. That happens when the loan does not get paid back. The loans are taken from the participant account, so they're paying themselves back. So it's not the same kind of default as like they defaulted on a commercial loan. There's no credit report involved or anything like that. But when the loan does not get paid back and it's defaulted, the amount of the outstanding balance becomes taxable income for them and is subject to those early withdrawal penalties. So we want to avoid that if possible. Way number one is do not allow participants to send in payments on their own. All payments should be done through your payroll system and deducted straight from their paycheck. Way number two, make sure you get those payrolls changed and get those loans set up immediately as soon as you know that there's a loan been issued for your plan. Make sure you review that start date and then enter a total goal amount into your system. It'll be the number of payments times the payment amount. And once the system has reached that goal amount, the loan repayments can stop. If your participant goes on a leave of absence, you want to make sure that you let your record keeper know, let NOVA know. So a loan can be put on hold for up to a year for an approved leave of absence. Things like maternity leave or a short-term disability, any kind of approved leave of absence for up to 1 year. This will not extend that 5-year clock for the participant. They still have to get the loan paid back within 5 years. But it will avoid a default. Once they come back to work, you can let us know, and then we can re-amortize the loan, get you a new schedule so that they can follow and make sure those loans get paid off. One thing to note during a leave of absence, the loan is going to accrue interest, but they will not be defaulted on. So just be aware of that. Loan defaults, if I've seen it happen where a payroll system was changed and the loans didn't get set up in the new system correctly, it can be a very costly mistake. So if you notice any issues, any errors in the system, you notice missing repayments, let us know right away and we can help you fix it. So if you do have missed payments, it happens, not a big deal. We do have some options. If you're only missing 1 or 2 payments, not a big deal. The participant could make a lump sum payment that just adds up everything they're missing, and they could make it, so let's say they missed 1 payment because of a payroll system error. And that next paycheck, they can make 2 loaner payments in one, get that submitted to the record keeper, and then you can just continue following your schedule. If you're missing more than just a few payments, the participant probably can't afford to make a lump sum payment, and that's okay. We can re-amortize the loan for you. We'll basically take the current outstanding balance that accounts for any accrued interest, and we'll give you a new schedule that you can follow from that point up until the maturity date of the loan. We're not going to refinance the loan, so the terms of the loan, interest rate, things like that aren't going to change, but the payment amount can change so that you can get the loan paid off still in time. There is a grace period. It's kind of a mouthful, that sentence there. But the grace period is you have until the last day of the calendar quarter following the calendar quarter that the first payment was missed. So if a participant misses a payment in January, you have all of that quarter, all of the next quarter. So you have until June 30th to get that loan fixed and start making payments again. It's the same amount of time though. If you miss a payment at the end of March, you still only have until June 30th because it's done by calendar quarters. So the sooner you let us know about any issues and with your loans, the better we can get those reamortized. And the process depends on your record keeper. Sometimes NOVA will be heavily involved in that, and sometimes we won't. But feel free to reach out to us and we can help guide you. Okay, now let's switch gears just a little bit and talk about vesting. So vesting is an employee's ownership right to the benefits in the plan. It's basically a way that they earn the money that's going into their plan. Now, they are not going to have to earn employee money, money that's coming out of their paycheck. They already owned that money. This is for employer money types. Think about your employer match, your employer profit sharing. They have to, quote unquote, earn that based on the number of years of service that they provide to your company. So certain money types are always 100% vested. They don't have to earn any employee money coming out of paychecks, any rollover contributions that the participant brought with them from their previous employer, safe harbor money, QNEC and QMAC sources as well. Those are always 100% vested. But your employer match and your employer profit sharing, think of those are the main two. There's two different ways that we can calculate this. So you earn vesting by working there. So for every year that you work for the employer, you get credit for a year of service, which increases your vesting. The first way is the hours method. This is probably the most common. 1 year of service is going to be based on a specific number of hours that's defined in your plan document. This is going to be a plan year basis, and it generally is 1,000 hours. You could lower that in your plan if you want, but I've never really seen that. People pretty much stick to that 1,000 hours. You cannot increase it above 1,000. It takes the average participant about 6 months to work 1,000 hours. You can hit it faster with overtime, but even a part-time person will generally hit 1,000 hours in the course of 12 months. So vesting is going to be calculated from the original date of hire, not when they became eligible. And then we're going to look at basically their date of hire until the end of the plan year. And then going forward, we're going to look at every plan year. And every year that they got 1,000 hours, they'd get 1 year of service. We can use the equivalency method. It'll be defined in your plan document. So if you don't track hours because maybe your employees are salaried or something like that, then we'll look at your plan document and it gives like a formula. So the most common one is for every month that they're employed, they would get credit for 190 hours. But you can have different formulas in there. It's all depending upon what's in your plan. The other way that you can calculate this is using elapsed time. Elapsed time is a little bit different because it's looking at the anniversary date. You know, literally, did they work here 1 year? Every time they hit an anniversary, that's when they get credit for 1 year of service. So we don't look at all about the hours worked. We don't care if they had overtime. We don't care if they're part-time, full-time, none of that matters. It is simply their anniversary dates. So we don't even look at the plan year for these. Okay, let's actually look at some real vesting here. So we have participant A. They've been credited with 2 years of service with this company. And this company uses a 3-year cliff schedule. So there's all kinds of different schedules you can use, and your plan document will specify which one you're using. 3-year cliff, it's there in the chart for you. You are 0% vested until all of a sudden, after 3 years, you're 100% vested. So this particular person has $5,000 in deferrals, $3,000 in match, and they have 2 years of service. So based on our chart there, 2 years is 0% vested. So what's their vested account balance? Deferrals, the money that they put in is 100% vested always. In this case, he was 0% vested in the match. So his vested account balance is going to be $5,000. If he were taking a distribution, 100% of his match would go to the forfeiture account for the plan. In this example, we have a person who's been credited with 4 years of service. And this particular plan uses a 5-year graded schedule, not a cliff. So this plan gives 20% for every year up until 5 years, where they'd be 100% vested. They have $2,000 in deferral, $1,000 in profit sharing, $1,000 in safe harbor match. Well, we already know the deferral and safe harbor are fully vested. So that's $3,000 right there. And then 4 years on a 5-year graded schedule is going to be 80% vested. So he's going to get 80% of his profit sharing. So his vested account balance would be $3,800. If they were taking a distribution, that's how much would be transferred to the participant. $200 or 20% of that profit sharing source is going to go to the plan's forfeiture account. So look at your plan. There's all kinds of vesting schedules that people use. I've seen some pretty creative ones. The maximum amount of time it takes to vest is 6 years, but as long as you stay within the regulations, you can do some different things. So, okay, I want to talk just a minute about avoiding some of the most common problems we see. So when a form is not in good order, we affectionately call them NIGO requests, or NIGO, not in good order. And we just want to let you guys know what these are so that you can kind of keep an eye out and maybe help if you see your participant forms when they're coming into us. Oftentimes we'll see that the participant didn't sign the form. If we have a request that the participant didn't sign off on it, we can't even start working on it. We're going to have to send that back right away, get the participant to sign off on it. If it's missing the plan sponsor signature, we can get that at the end, but we can't start without a participant signature. For distributions, like terminations is the top #1 thing we have to put on hold, and it's because we're missing the termination date. So that's when you'll get an email from us telling you we need that term date. One thing that we will always check before we email you is the record keeper website. So if you update your site to record keepers with the term dates as they happen, we'll check there first. And then if we find it there, we will not bother you, I promise. For loans, the #1 thing we're missing is the payroll frequency. We need that so that we can create the amortization schedule. And then the participants, for some reason, like to leave off the length of time that they want that loan to be for. Is it 1 year, 5 years, somewhere in the middle? And then the next payroll date. So I might know that a participant is biweekly, but I don't know if they get paid this Friday or next Friday, if that makes sense. So again, we're going to need that information to help us get the amortization schedule to match your actual payroll cycle. It'll be a lot easier for you if it matches. So that's definitely our goal. And for hardships, we often will get the request itself, but we won't have any kind of certification or documentation with it. So we'll need that certification and anything kind of documenting the hardship before we can fully finish that request. And these are the reasons we put things on hold the most often. So I just wanted you to be aware of that. I want to talk 1 minute, maybe 2, about cybersecurity, because this is so important. Everything listed on the screen here is an item that should never be sent via email without encryption. Basically, if it has somebody's social security number on it, their date of birth, address, anything that can identify a specific person, it's called PII. We should be sending these in a more secure way. And so NOVA can commit to telling you we are not going to be sending these out without encryption, and we would like to make sure that y'all are aware that it needs to have It needs to be, if it's coming to us, it needs to be coming to us in a secure way as well. We have plan sponsor links that you can utilize. You can send your information to us using the secure file transfer. We also have our team, the distributions team, set up in there. So in the secure file exchange, it's set up like a person that's called Nova Distributions. So let's say you have a loan form you want to send to us to process. You can actually choose Nova Distributions. It will come straight to our team and it'll get logged into our system and we'll start working on it immediately. You don't have to send it to your account manager. We do have encryption software. If you know you need to send something with encryption, but you're not sure how to do that, just send us an email. Say, hey, I need to send you something. Can you send me an encrypted email? We'll send you an encrypted email and you can safely reply back to it. You don't have to worry about encrypting it on your end. If you want to add a contact to your plan, we do have to authorize it with an existing contact. We're not just going to accept somebody calling us and saying, hey, I'm the new contact for ABC company. We're going to have to verify that every time. And just so that you all are aware, we do have mandatory training for every single Nova employee every single quarter. It doesn't matter how big or small of a job, part-time, full-time, everybody does the training. And then we have policies where we change passwords every 90 days. We are constantly looking at ways to increase our security and to make everything more secure. We treat your participants' information the same way we would want our information treated. So, okay, we're pretty much at the end. Just a reminder on the CPA credit, look for an email that you should get within an hour, give or take. I think they usually come in a little bit faster than an hour. And then within a week, you should get your certification in your email. With that, we have our contact information here, and we're ready for any questions y'all might have.
Alrighty, our first question is, can you explain the rollover option available to participants who have received a distribution from a plan with the 20% federal taxes withheld?
I think I can take this one, Melissa. So there is an option for participants if they've received a cash distribution to still make a rollover. It's a 60-day rollover, I believe is what it's called, but they have to do that to an IRA. They can't do that to a qualified plan. So if a participant has received a cash distribution from their prior employer's plan, they can then deposit that into an IRA along with the tax withholding that they have to make up from their own funds and go ahead and make a rollover that way so they can avoid or defer the taxes on the distribution.
Alrighty, our next question is, can you please explain plan options available if a participant terminates with a loan balance remaining?
So if a participant has a loan balance, they've got a couple of options. Option one is that they can go ahead and pay off their loan balance. And then if they want to take a rollover, they'll be able to roll their entire account to an IRA or to another plan. Another option, if they take a cash distribution, they can just pay income taxes on their remaining loan balance. Or if they don't take a distribution at all, eventually the loan will default and they'll be taxed on the remaining balance. And I think Melissa went over that cure period when she was doing her part of the presentation. So that's that, end of the quarter, after the quarter, that they terminate or make their last loan payment. If they don't do anything about their loan, it will default and they'll be taxed on the remaining balance.
And that is the last question. All right, perfect. So we'll go ahead and close this out. Just a reminder, go ahead and fill out the pop-up survey at the end of this webinar. This will allow us to track who will be needing a certificate. If you have any questions, please be sure to reach out to Melissa or Stephanie, or you can email us, webinars@nova401k.com, and we can go ahead and forward that over to them. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you, Melissa and Stephanie, for your time today. And thanks again to everyone for joining. We hope you enjoy the rest of your day. Bye.